Hi everyone, my name is Vess Rusev and this is episode 29 of the East Auckland Property Show. Thanks for tuning in, thanks for coming back, and today I welcome you to Brandon's beautiful office.
Thank you. This is my desk.
We have a beautiful winter day in Auckland, so we're gonna take full advantage of it. So we had an interesting question on our YouTube channel a couple of days ago from Naomi, and this is the question. So Naomi wants us to cover a few things related to buying your first home and what are the main difficulties with it. So Brandon, from your perspective, from the financial perspective, where do you think lies the biggest difficulty for people who are looking to buy their first home?
The biggest difficulty is probably, I think, understanding how the bank calculates the mortgage repayments on its calculator when it decides the affordability.
Sorry, so the first step is someone is thinking of buying, they go online, they go to the mortgage calculator.
Exactly.
And then
Which is what Naomi, well, I think from Naomi's question, that's what she was touching on. Because she asked about why, the increase in the ratio from house prices to income.
Yes.
Which has happened. That's happened. House prices have increased, in case you haven't been around for the last 4 years.
Yeah.
House prices have increased significantly, and incomes haven't followed just yet. So with that lies the problem, because when the house price increases, the mortgage obviously increases as people borrow to make up the difference. And then those repayments typically increase as well.
Yes.
So, like you mentioned, one thing that I've noticed is very common with first home buyers is they'll go to a bank website and they'll use either a bank calculator or they'll take the special interest rates from the website.
Yes.
Then they'll find a mortgage calculator. I've got one here with us because we're going to run through some figures and an example. And then they'll calculate the repayments and base their affordability off their own back-of-the-napkin calculation to see whether or not they can afford a house.
Yeah.
So say, for instance, I've got some numbers I was thinking we can use. So we can just say, if you're going to borrow $500,000 to purchase a home, so your mortgage will be $500,000 over a 30-year period, which is the longest it's typically the longest that you can take a mortgage out for. And just if we're pulling, say, one of the special rates off a website today, 3.79. That's as of today.
Okay.
So that's the 1 year interest rate.
Is this based on 10% deposit or?
Well, we'll get to that. That's just I'm going through the journey of what someone who perhaps hasn't had this explained to them might do. Yeah. And we're going to start to uncover some of the mistakes.
Yeah.
So 3.79. That's the lowest rate on a particular website. We're going to take that rate. We're using $500,000, which is what we like to borrow over a 30-year loan period.
Yeah.
And then the weekly repayments are $537 a week.
Okay.
On those metrics. And so then a couple might look at that and say, that's awesome. We're paying $600 in rent per week. Yeah. We can afford this because we're saving money from day one. Well, firstly, you would be if this was the mortgage that you're going to take. Yeah. But right off the bat, we haven't included any home ownership costs like insurance of the property, which is going to be perhaps over $1,000. Yeah. Any rates as well too, which could be a few hundred every month that you need a budget for. So immediately people start adding at least another $100 a week on top of their repayments to calculate for ownership costs. So immediately from day one, you won't be paying, on these kinds of numbers. Yeah, you won't be saving money by moving into the house for starters. Yeah. But let's look at the affordability, because the bank includes that for one, the home ownership costs. So you haven't included that as a borrower. Yeah. So they'll add that into the calculation. But I think the next thing that's really important to note is that the bank doesn't test your affordability of the mortgage based on the best interest rate today. Oh, okay. So they actually, they stress test it, and that for most banks will lie above 7%. So
that's more than double.
Yeah. So say if we pick one, we can go to just say 7.8%, for example. which is roughly a rate that's used in today's market to test mortgage affordability. 7.8% is more than double of what that 3.79.
Yeah.
So per week, that's actually 830 per week. So,
and then you have insurance.
And then you put it on top of that.
Rates.
So if you're adding another 100, it's gone to 930, and you were looking at repayments of 537. So if we've got 537 and 830 less 537, and we can add another 100 on top of that. There's 393 per week. That wasn't calculated.
You haven't budgeted,
Yeah, and I think that's really one of the first steps, is that it is that affordability. It is stress tested, and that's different at different banks too.
So is it a little bit misleading using those calculators, or
it potentially can be? It's good to understand what a calculator is only as good as the information that you put into it, right?
Yeah.
And that's part of the advice piece, and this is what we work through as mortgage advisors. We work through with our client's scenario, and we run through, one, the calculators that are being used, and then two, the right information, for example. So the stress test element too. So, I mean, that's another 1,700 that we've missed per month on the expense side of things, which will dramatically affect how much you can buy. I think in knowing that,
which is another income.
Yeah, exactly. It's another income. You're exactly right. And I think that this really points to, I guess, the one thing is what I've seen. First home buyers who have been very successful, who have very realistic and quite modest and humble expectations. I've seen that they actually do a lot better in searching for properties, and for knowing that if they have $100,000, that they don't have to buy a $1 million property because it's a 10% deposit. When you start looking at stock that's a little bit less expensive, like anywhere from say $650 to $750. Heck, even 800, your affordability improves a lot, and the total mortgage cost also decreases too. So yeah, I mean, if I was to give you an example of like a fairly expensive mortgage, say if there was someone who had a $100,000 deposit, and they were looking to buy something for $1 million, your mortgage would obviously be $900,000. I'm going to use an interest rate of 4.5%. One thing that was touched on in the question as well is why is the mortgage slightly more expensive?
Yes.
Right?
If you are borrowing with
less than
20%. Yeah.
And so the way to look at it is the bank gets a big pool of money that they borrow from other banks and the Reserve Bank, etc., and their profits, and they have it in two categories when they look at first home buyers. They have a big chest that's full for deposits for borrowers for 20% deposits, and then they have a much smaller chest, which is about 15% of the size of all of the funds, that they'll be able to lend for anything less than 20%. And those rules aren't set by the banks themselves, it's set by an external bank, the Reserve Bank. And that's roughly where they want to sit, is that 15% can be lent out below the 20% deposit rate. And because of that, it's natural supply and demand. The money is a bit more expensive, plus the bank pays for things like insurances. It's slightly riskier, because those properties can all of a sudden, if there's a 10% shift in market value, then you lose that equity in that property as well. So it's the bank's way of protecting themselves. But look, realistically, 4.5%, about a year, 18 months ago, people were taking 4.5% interest rates. So, and the house prices haven't changed. So even though stuff is cheaper today, it's at special today versus it used to be for 4.5. So yeah, that's the reason why it is a little bit more expensive. But and again, it doesn't mean that everyone would get a 4.5% interest rate. It depends which bank, how much the deposit is. But I think this is a fair number to use. So using 4.5, if you're going to borrow $900,000 for a first home, and you're going to buy something for 1 million, and you give 100,000, so it's a $900,000 loan. Your total weekly payments for interest alone is $779, so almost $800,000.
Yeah.
So that's to own the mortgage. So that's from the first repayment, and obviously, as you pay the loan down, that number slowly gets lower. But every payment, you've got to start chipping through $779 before you start hitting the premium debt. So that's your dead money. Then you'll add the 100 minimum for the other expenses. So it's $879. Like realistically, we should just round that number to 100 because $100 a week for home ownership costs wouldn't cut it. So let's say 900 is what you'd be paying for $900,000, and that's your dead money.
Yeah,
that's out the door. But if you're going to buy something for $750,000, you had $100,000 deposit. Your mortgage is going to be $650,000, and that already has gone down to $563 per week. The interest cost for that, again, plus 120, it's $680. So from day one, it's $220 a week. It's $10,000 cheaper a year to live and own in that property as well. So, same deposit amount. Sure, the property is going to look very differently, but I think that's the decision that people should start weighing up. Is it worth $10,000 more every year to live in this house, or should we be moving into something that's a little bit cheaper?
Yeah.
So,
and it's interesting by saying that the banks will have around 15% for first home buyers.
Yeah.
Or for loans that are with less than 20%.
Yeah.
Because looking at the latest statistics, we see not only in Auckland but throughout the country, we have 25+% of the transactions that are happening are going to first home buyers.
Yeah.
So you see you have 15% money, and then you have 25% of the transactions are first home buyers.
Yeah. So there's two things I was thinking about when you started saying that. Is firstly, I've got a client that I'm meeting with today again. We've met with before, and they're having a lot of difficulty in buying or we actually were unable to get them a pre-approval for a mortgage with less than a 20% deposit, and they earn excellent income. And the reason why is because underneath that 20% spot, because there's so much less money available, the pre-approvals that you get given and the way that a bank will assess an application is different amongst each of the banks. So if you aren't a main bank client of a particular lender, for example, this is on today, you have a less chance of having your application perhaps prioritised. Preference is given to the existing clients. So say if you bank with Bank A and you look for a pre-approval with less than a 20% deposit at Bank A, then you have a very strong opportunity to get that pre-approval there. And a pre-approval is an indication that the bank has looked at all of the numbers and the information they have today, and they're happy with it. There's still got other things to look at, like the kind of property that you buy. And then it's subject to availability of them actually having that money too. But say for instance, if you're with Bank A and Bank A, they've got the money and we could do an application there, but for some reason that Bank A wouldn't be the best bank for you, and someone else might be doing say a better deal, or they might let you borrow a little bit more, or they might be able to do it a bit quicker, then if you have less than a 20% deposit and it's a pre-approval, then you can't actually, some of those other banks might not look at your application because you aren't an existing client, and they're prioritising theirs first.
Which is, you have pre-approvals on one side, and then you have live deals on the other side.
Yeah, live transaction as well. So
which is, they're always prioritised.
100%. And so, looking at the numbers for this client situation, there's no doubt in my mind that all the numbers check out, and that with confidence I know we're going to get an approval, but he has to find a property first. But first home buyers would sometimes like a pre-approval because he's looking at auctions and going to stuff where he needs the confirmation beforehand. It's a very chicken and egg scenario. But how we've solved it is that his parents and parents-in-law, they're gifting a small amount to just bridge that gap. So now he has a 20% deposit. So now he fits in the mainstream bucket, and then that opens up all those options again. So that's one thing, is the gift is something that can overcome that. And we covered the... We have, for sure.
The gift of... money from the family. But do you think it's a, from your perspective, is it the better advice people not to get the pre-approval, but to go and straight put an offer on a property without the pre-approval?
Yeah, it depends if you can get the pre-approval or not, and it depends how confident you are, and who's advising you behind as well. Like if you have like a very good advisor and someone who can give you the confidence to say, hey, look, yeah, everything does check out from what I can see. If we want all of the options, and this is what a few of our first home buyers have had to do, they've had to trust us and say, hey, look, we've had a look. We reckon we can pull it off. We reckon, sorry, you can pull it off because it's your stuff, right?
Yes.
We reckon you can pull it off. Let's go find something, and when you find it, we're going to prioritize it here. The banks will prioritize it. They do turn around very quickly for a live transaction. So it's initially that trust piece, and if people do trust that and they have had their things looked over, then it results in a very positive experience. So yeah, I would be saying, unless if it's a 20% deposit, a 20% deposit, hands down, approval, no problem. But if it's less than that, you really do need some advice and guidance around, hey, can you, if you can, where, if where is best for you anyway, and putting together a strategy and plan of attack, because there's different products, different banks, different lending.
How long usually does it take just to for a, because this will be a pre-approval, right? It will be just initial assessment.
So it could take, I mean, it's as simple as probably having a conversation with a good broker or a good advisor. And that can take between 10 to 15 minutes. But because it's a trust-based exercise now,
it takes more time.
It actually takes longer. It actually takes now sitting there and explaining a product and hearing how the search has gone so far, have they begun, things to look out for, you know, so you can actually do a very strong, or be educated, you know, quite strongly and given the right direction. And then when it comes time to put the offer on, then that's when the you know, the collection of of more documents will come through, the sale and purchase, up-to-date bank statements, all that. Then your due diligence on the finance starts. So it's a different kind of a beast.
It is. And it's interesting that we also give a little bit of pressure to people who are buying for the first time. We always, as agents, ask for, do you have a pre-approval? What was the pre-approval up to? And you know, some people will share with us, some people won't share.
I understand.
And this is where most of the first home buyers will try to get a pre-approval. But you're saying that you can always, it's probably, is it worth the risk to go for without a pre-approval, just to put an offer? Only with a discussion with a mortgage broker.
Yeah, I think so. And then when the property, and keep in mind that while a lot of the decision is based around, like a decision to lend money is based around your financial position, a lot of weight is put on the property itself that you're buying too. So, you know, if you're buying a property that has perhaps some weather tightness issues, for example, that can negatively impact it. You know, so typically it's something that will, you know, if you're looking at a property and there's something bad on it, there's nothing on a property that will, you know, make it, like, in my opinion, a very exceptional, you know, like a very exceptional security. You know, it's either acceptable or it's very not acceptable. It starts at the average and goes down. So, yeah, I think, you know, that's what I'm saying, is that you should probably consider it, and as long as you've been advised correctly, and you've had someone else look over your position to say, hey, yeah, you can do it, and you've been guided around the conditional period so that you know that it's a safe offer to make, and that you know that you've got your due diligence clauses in there. So as long as you're well informed before going into it, then what happens is, at that point, you actually force the lender to make a decision on whether or not they want to be a part of this transaction. And sometimes, because it is a live transaction, that's when sometimes there can be a little bit of magic. You know, sometimes it might not fit the box. But for some reason, on that day, the rule just gets a little bit bent in your favor, and you can't sometimes get that in a pre-approval. So when stuff's very, you know, in grey, which doesn't happen a whole lot, but for some reason always happens with first-time buyers. The cards will sometimes just fall in your favour.
Because with pre-approvals, there is no priority, there is no urgency.
Just checking the numbers.
Checking the boxes. There's that. And when you have a live transaction, you have the urgency. It has to happen in the next 10 working days.
Exactly.
And what would you suggest is probably a safe or a reasonable
time frame
for finance condition? If you're a first home buyer.
Yeah, if you're a first home buyer.
Probably depending on the KiwiSaver and if you're gonna use it or not, but
yeah. So the KiwiSaver one, I don't know if you had a conversation with your lawyer yet about the KiwiSaver and the withdrawal process yet.
I don't remember.
Okay, well if you
well, we discussed it with you. I remember in one of our previous videos.
Because I know solicitors that KiwiSaver withdrawal process can sometimes be quite lengthy.
Yes.
So you want to start that a lot sooner than later, and I think that the solicitor is really the main driver for that.
Okay.
Where as brokers or advisors, we can certainly remind you to start doing that. We don't do that on behalf of clients, but if it's anything under 5 days for finance, really asking for trouble. 10 days is quite standard, and I'll let you know why. So what happens with a first home buyer is why 10 days is probably best is because...
Which is 2 weeks, right?
Yeah, it's 2 weeks, and it's acceptable.
Yeah.
Right?
Yeah.
If all of the information is collected from day one, if you have less than a 20% deposit, you need evaluation still. But evaluation costs money.
Yeah.
So clients typically don't want to pay for evaluation if they don't know that they're going to get finance approved.
Yeah.
So you want to get finance approved, and even if finance approval is going to take, say, 3 days, right, from the moment that the application is sent.
Yeah.
Say if it's going to take 3 days, on day 3 you might get some questions back, and then you might have to answer some stuff to the bank, and they might need some more information that's been missed, for example, which is relatively common.
Yeah.
That might take another 24 hours until you get an approval letter back, which is day 4. And then you're going to have the condition of a registered valuation. Then you have to book it, order it, they have to come in, and then that might be another 3 or 4 days. And then you have to get the valuation, then you have to supply it to the banker, and then the banker has to approve the valuation too. So now you're actually at 10 days, so that you can do your due diligence from finance, which the valuation piggybacks off of, because the finance is free, but then the valuation costs, and you don't want to pay
around 700 probably. Valuation.
Yeah, and if you're going to do a building inspection and a valuation, and you're going to, if there might be other stuff that you're going to meth test, or if that might be in the building or the weather tightness,
asbestos testing.
Yeah, and so you actually pencil all that in until you've got the finance, so that you can do it. And then you start pulling the trigger on all of those. So really 10 days, because that influences your other... Yeah.
And then if you want to use your KiwiSaver and you haven't started the whole process, but you will be starting a process from day 1 of the 10 working days, probably you need to allow
you can
another...
get it approved.
Okay.
Yeah, you can get it approved as long as the settlement date isn't really short.
Yeah.
Because then you might have difficulty drawing the funds out. So you can definitely go if you haven't got it approved to draw out, you can definitely get that done in 10 days.
Yeah.
But getting the money out will take quite some time.
So what would be a safe settlement date if you're borrowing money for a first home?
If you start everything from day 1, I'd say, like the soonest you'll probably do it is 2 weeks, 2 business weeks, so 10 days unconditional. Settled 10 days after is probably the absolute shortest time frame.
Okay.
But with that, then I know that you need 21 days for your KiwiSaver to come out. So that's a day shorter than that.
Yes.
So you'd then be relying on your KiwiSaver coming out sooner, which
probably 4 weeks.
So then 3 to 4 weeks settlement date afterwards to be really sure.
Okay.
And you've got to also remember there might be other things too, like you might have a lease that you have to cancel for your current place. Then you got to pack.
Yes.
Right. So and you got to change all your addresses as well. So there's a big, you might need different new furniture and all that, and that's going to cost you money. So then you have to figure out all these things, those things too. So it has to fit in with, it's a big endeavor.
Yeah, it is.
Yeah,
it is. But there's steps that you can follow to make it less stressful.
Yeah, 100%.
Yeah. So probably first thing will be talk to a mortgage broker, just to get an idea what you can borrow.
Yeah.
just an initial idea, right?
Yeah, and again, everyone's going to have their own unique stuff and need to go down a different path, down the bank route, and everyone has their own unique questions that you need answered to be empowered and have the confidence to go out and start looking at properties. And I think that's the thing is most of my time spent with first home buyers with less than 20% is actually spent empowering them to be able to go and do it. Because if you have the numbers, you know if you have they're actually quite good at selecting whether or not they can do it. We're not needing to pull off any magic at the moment. There are people who have over a 10% deposit, who have good income, who are looking to buy something in the current market, and then it's just the how-to, and it's just answering questions, being there for them, and then directing them, and just covering up the gaps of their knowledge. And then I think that's where, because we don't know what they don't know, we can only do it by having a conversation. That's why questions like what Naomi's asked are really good.
Absolutely. And she said that she's in the process. She already had signed the sale with purchase agreement, but just wanted to know more, probably for buying a next home or people to
family
know more.
Or friends. Okay.
And then probably the second step will be get a lawyer, talk to a lawyer. So you get that legal advice before you start the whole process. So you have the financial side covered. Then you have a lawyer that will give you the initial things that you need to do, and there are lawyers out there that will charge you a fixed fee, so they won't be watching their clock. So it's always good to find someone like that, so you know, and you can factor in, you can, those expenses, those fees.
100%.
And that's anything else we need to this topic?
That's it. There's a lot there. If there's any more questions, I mean, keep them coming. There's a lot to talk about. So
So if you have any further questions around the topic, and I know that it's a hot topic, we've covered buying your first home before, and we're gonna keep covering because this is the main pain point for a lot of people. Just send your questions, and we're gonna make sure that we're gonna answer them in some of our next videos. So thanks, Brandon.
No problem.
Thanks for the time, and see you next time, guys. Thank you. Bye-bye.